Welcome to today's session on capital budgeting, a cornerstone of strategic financial planning. Capital budgeting is the process companies use to evaluate and decide on potential long-term investments or projects, such as buying new machinery, launching a new product, or expanding operations. Capital budgeting decisions are crucial because they involve large amounts of money. The decisions are long-term and irreversible. They directly impact a company's growth and profitability. Let's delve into the core techniques used in capital budgeting. One is the technique 1. Payback period, PBP. This measures how long it takes for an investment to generate cash flows sufficient to recover the initial investment cost. Shorter payback periods are generally preferred. Pros of PBP is that this technique is simple and quick to calculate. Second technique, 2. Net present value NPV. This method calculates the difference between the present value of cash inflows and outflows over a project's life. A positive NPV indicates a profitable investment. Pros. The pros include it considers time value of money, cash flows throughout the project's life. 3. RD technique. 3. Internal rate of return IRR. IRR is the discount rate that makes the NPV of all cash flows equal to 0. If the IRR exceeds the required rate of return, the project is considered favorable. Pros. The pros include it considers time value of money, useful for comparing projects. Fourth technique. 4. Profitability index PI. OPI is the ratio of the present value of future expected cash flows divided by the initial investment. A PI greater than 1 suggests a good investment opportunity. Pros useful when capital is rationed. Fifth technique. 5. Discounted payback period. The period in which it considers the time it takes to recover the investment in present value terms. Pros accounts for time value of money. Better than PBP considers TVM. Summary. Which technique is best? NPV is generally considered the most reliable method because it directly measures added value. IRR is intuitive and popular but can be misleading in certain cases. Payback period is useful for liquidity-focused decisions. PI is helpful when investment funds are limited. Thank you for joining us in this exploration of capital budgeting. Stay tuned for more insights into financial decision-making.